Welcome to Chapter 8, Finance and Accounting. At the end of this presentation, you should be able to understand the importance of money and explain the differences between stocks and bonds, describe the steps in the accounting cycle and explain different areas of accounting, explain how the major financial statements differ, as well as explain the importance of ratio analysis in reporting financial information. The first step is, why should we study accounting? And we should study accounting to monitor revenues, expenses, and losses better. It's important to know about the finance and accounting as a business person. Knowing a bit about accounting can make a business owner more informed, and they can monitor their bookkeepers and accountants if they understand a bit more about accounting. And understanding the importance of money and explaining the differences between stocks and bonds, it's important to understand that money is defined as anything that people generally accept as payment for goods and services. There's also bartering, which is the trade of goods and services for other goods and services. The standards of money, such as portability, it must be easy to carry around. Divisibility, must be able to divide it, and that's why coins are an important part. Must be stable. When everyone agrees on the net worth or the worth of a currency, it needs to be more or less stay at that value. It needs to be durable. Since it passes through so many hands, it needs to last. It needs to be unique. Money must be unique enough so that it's not easy to counterfeit. So moving on, we're going to take a look at securities markets. Securities market is a place where stocks and bonds are traded. Markets in the U.S. such as NASDAQ, the New York Stock Exchange. And the purpose of these securities markets is that it offers a place for companies to trade their stock, which generates money for the company. And it's done through an IPO, which is an initial public offering. It's the first time a company offers stock for sale, and then after that, it continues on with the sale and purchase of stock. The Securities and Exchange Commission is the organization that sets the rules for stock exchange. So moving on, next we're going to take a look at bonds. A bond is a corporate certificate that indicates that money has been lent to a firm, and it includes a maturity date, and the maturity date is the date the bond must be paid back. There are some advantages and disadvantages for bonds. Some advantages are the owners or creditors not owners of the company. The interest paid is tax deductible, it's temporary, and it can be repaid earlier. Some of the disadvantages of bonds is that selling bonds increases debt, paying interest is a legal obligation, and the face value must be paid on the maturity date, so careful planning is required. Now in comparison or in contrast to bonds, you have stocks. And stocks is actually a part ownership of the company, and the dollar amount assigned to each share is the par value, and it does not represent a market value, which could be higher or lower. There are dividends, which are profit that might be distributed to shareholders, and there are some advantages and disadvantages to stocks. Some of the advantages of stock is that stocks never have to be repaid. There is no legal obligation to pay dividends. Many companies do not, so they can reinvest profits into the company. And selling stock does not create debt like bonds do. The disadvantages is that shareholders have a right to vote for the board of directors, the leadership of the company. Dividends are paid from profit and are not tax deductible. And management decisions might be affected by the need to keep shareholders happy. For example, the company can't do whatever it wants, it's accountable to the shareholders. And there are different types of stock. So, for example, you have common stock, which is the most basic form of ownership. And the owners have voting rights for board of directors, and it earns dividends if the company pays them out. There's also preferred stock, which is in preference in payment or of dividends. And there's a priority claim on assets. And the owners of it do not have voting rights. So that's the difference between stocks and bonds. So we'll move on next to the accounting cycle. An accounting cycle, what exactly is accounting? And accounting is the recording, classifying, summarizing, and interpretation of financial information. And there are two different types of accounting. For example, there's managerial accounting, which provides information to people within the company. So it's the accounting that gives managers the information they need to make decisions. And there's also financial accounting, which provides information to the people outside of the company, such as annual reports. And there are different types of accounting rules. There's a Financial Accounting Standards Board, which oversees the standards for accounting, so everyone does their accounting the same way. And that helps to regulate financial reports and other items that there needs to be some sort of continuity so everybody knows what's going on and everybody's doing it the same way. And there's GAAP, which is known as Generally Accepted Accounting Principles. It's the rules that accountants must follow. And just like there are different types of accounting, there are different types of accountants. There's the CMA, which is Certified Management Accountant. It's certified to do managerial accounting. There's a CPA, which is a Certified Public Accountant who is able to work for the general public. They must take tests and follow guidelines to be certified. There's also private versus public accountants. And public accountants do not work for a specific company, while private accountants do. And there are different types of accounting. For example, not just managerial or financial, but we're looking at what they do. And this is auditing, which is the job of reviewing and evaluating the records used to prepare financial statements. And public companies must have an external audit before statements can be released, and that helps keep everybody in check and make sure that everybody's being accurate and ethical with their statements. There's tax accounting, which is an accountant who works with business and taxes and calculates the taxes that is related to that business. And there's also government and nonprofit accounting. And this is the type of accounting that must follow stricter standards, the Government Accounting Standards Board of Rules. So moving on, we're going to take a little bit more at the accounting cycle. The accounting cycle is you begin by analyzing documents. So you're going to take a look at invoices, receipts, gather up those documents and analyze them. You're going to record transactions, transfer usually to a ledger spreadsheet or a financial or a electronic ledger spreadsheet. Then you're going to have a trial balance. That's a summary of all financial information. Then you'll prepare financial statements such as income statements, balance sheets, and cash flow statements. And then you'll analyze those financial statements using ratio analysis. Now, financial statements are a summary of all of the transactions that occurred during a particular period. And you have three basic ones, which are the balance sheet, income statement, statement of cash flow. And basically it follows the accounting equation, which is assets equals liabilities plus owner's equity. Now, taking a look at these three statements, the balance sheet, the income statement, and the statement of cash flow, the first one we'll take a look at is the balance statement. And that reports financial data on a specific date and time. It refers to how fast an asset can be turned into cash. And assets are considered a thing of economic value, such as land or a building or cash. Now, there are also some harder to place, monetize assets, such as a brand. Coca-Cola, the brand name, that's considered an asset, but it's not something that would generally appear on the balance sheet because it's harder to put a dollar value on. Balance sheet also takes into consideration liabilities, and that's the amount that a company owes to banks, creditors, and bonds, etc. So the next one is the income statement. And the income statement summarizes all of the resources that have come into a firm and looks at expenses of the firm. So you consider revenue, which is the value of what is received from goods or services sold, gross sales, the total of all sales received from the firm, and net sales, which is gross sales minus returns or discounts given. There's also cost of goods sold, which is the cost for materials and supplies used in producing the goods. Gross profit, the profit margin, which is how much the firm has made without taking into account expenses, as well as operating expenses, and these expenses necessary to run the day-to-day operations of the business. So the next statement we're going to look at is the statement of cash flows. The statement of cash flows is reports on the money coming in and money going out of the business. And it's geared towards looking at the operations, investments, and financing, and shows the firm's position of cash on hand. It's important to know how much, so unexpected expenses or revenue shortfalls can still be covered. And as you mentioned, one of the ways that people will take a look at the financial statements is through ratio analysis. So some of the ratio analysis include liquidity ratios, leverage ratios, performance and profitability ratios, and activity ratios. The liquidity ratio, for example, shows how fast a company could turn assets into cash. The leverage ratio shows the amount to which a company relies on borrowed funds to run a business. Performance and profitability ratios take a look at earnings per share. For example, how much profit is generated for each share of stock. There's the return on sales ratio, which is part of the performance and profitability ratio. And the return on sales tells a company how much profit it earns based on every dollar generated in revenue. Another one of the performance and profitability ratios is return on equity. This calculates how much was earned for each dollar invested. And finally, there's activity ratios, which is considering inventory turnover, and it's often used in retail to show how long it takes for the inventory of a business to turn over. Of course, the more it turns over, the more profit that can be made. So at the end of the presentation now, there is one Easter egg that is relevant to the business project that it usually causes the most stress for students. And that is, yes, you're going to need to have the financial statements as part of your homework and part of your term project. However, I am not expecting you to create from scratch these three financial statements. That would take a lot longer than the amount of time you have in order to do an adequate job with that. However, what I am looking for you to do is to make sure that the financial statements that you generate or borrow from an existing company, that the numbers within the financial statements stay consistent throughout the business plan. So for example, if you're talking about income in the financial statements, you should be talking about that same level of income in the rest of the business plan. So what you're going to be doing is generating the income statements and then referring to the numbers from the income statements to show how you're going to be successful, and why you should be, why somebody should invest in the business, and why you should be given a loan, how you're going to finance the business. All these statements will help identify those issues, so you're going to be explaining that. But keep in mind, you're not expected to generate these from scratch. You can borrow information. Just make sure when you borrow the information, you provide a citation in APA format that shows where the information came from. We want to make sure that we're keeping track of our academic integrity standards. And if you have any questions, please feel free to touch base by email, phone, text, smoke signals. Have a good week.